Welcome to The Winning Trade. Each episode in this series will demonstrate how to make money in the stock market, whether the prices are going up, down, or sideways, using high probability, profitable strategies that were designed to take advantage of the volatility of the Russell 2000 and the S&P 500 indexes. Many of these strategies were designed to work together to maximize profits by flowing with the ever-changing market conditions. Follow along as we uncover the secrets of this episode's Winning Trade. Hello everyone, my name is John Locke and I'd like to welcome you to this episode's Winning Trade. But before we do, let's go over our required disclaimer material. Let you know that this presentation is given for educational purposes only. We're not broker-dealers or financial advisors, and we're not making any specific trade recommendations. Also, please be aware that your risk in trading options is substantial, and make sure you're aware of all your risks prior to placing any trades. Please note that we are using hypothetical computer simulated trades or results unless it's stated otherwise. They are believed to be as accurately represented as possible, but keep in mind that live results can vary from simulated results for many different reasons. If this happens to be your first experience with us, my name is John Locke. I'm a trading performance and wealth coach with Lock in Your Success LLC. I'm here to guide you into the realm of high probability trading. Now in a moment, we're going to go over the winning trade, but before we do, let me quickly explain what we mean by high probability trading strategy. An income strategy is where we put ourselves in a position to generate profits through the passage of time rather than depending solely on price movement to go in the right direction. Meaning we can often make money whether the price goes up, down, or sideways. Now this doesn't mean we're going to win all the time, but it does mean that the probabilities of us winning are much higher than they would be if I was trying to do something directional or something like that. Now, if you find yourself in need of more information when you're following along, that's fantastic. It means you're learning, and to help with any information you may be missing, simply contact us at lockinyoursuccess.com or ask a question in the comments in this video, and we can direct you to where you can find more information. Okay, so let's move on. The winning trade we're looking at today is called a Bearish Butterfly. The Bearish Butterfly is one of three primary trading structures that we utilize in what we call the rock trading system, and it's designed to maximize results in very choppy and bearish market conditions. It is entered 56 days to expiration as a butterfly with 50-point wings, with the short strikes approximately 20 points below the money. Something like this. This here is what we call a trading matrix. You can see the asset price right up here. It's 1587.90. So we come in about between 20 and 30 points usually behind the money, and that puts us, if you go 1580 minus 20, that puts us at 1560 short strikes. We are 50, in this case 55 days to expiration is actually an error in the software that's telling us it's 55, it's a day off. We have our 1560 short strikes, and we have wings that are 50-point wide, meaning that our long strikes are up here at 1610 and down here at 1510. If we take a look at our analyzed graph, if you remember, this graph has the price of the asset along the bottom. It has our profit and loss up and down. This straight or series of straight lines is the value of our position at expiration, and this curved dash line here is our value as of today, or at least our projected value as of today. So the way this works is this is what we call a 10 lot. In other words, we're running with 10 butterflies. A 10 lot bearish butterfly has a $50,000 planned capital, so that's a lot of money, $50,000 in there. It has a 30% profit target on that planned capital of $15,000. It has a maximum loss of $15,000. The profit target on this strategy reduces to $5,000 when we reach 21 days to expiration, if we haven't yet hit our profit target or our max loss by that point. This allows us to get out of the trade a little bit early and avoid getting too close into expiration most of the time. Now, the way the strategy works is I'm going to put the analyzed graph. If the market comes down into this range here, we simply exit this position and we reposition what we call at the money, or with our short strikes pretty much where the asset price is at the time. And if this goes up, what happens is we scale in, or in other words, we make our position size bigger. So if we were to go up from here, say about 20 points, we're going to add another butterfly in, or a second butterfly. We may even call a second tranche of butterflies since we have 10. And then if we go up another 20 points, we add more butterflies, with the idea that the market eventually retraces or comes back to mean. And at that point, we get into a very large position at very good pricing, and we can make money relatively quickly. If we're wrong and the market continues higher, we then initiate a rolling sequence to stay up with the market price until it stalls or comes back where we can make a profit at that point. Of course, if it goes up too far, then we may take a loss. And if it comes down a lot, most of the time, this strategy with the adjustment strategy to the downside is going to win regardless of how far the market goes down. Later in the trade that could change, but certainly early in the trade that is the case. So let's take a look at, let's take a look at the market first. So this is what the Russell 2000, this is the RUT, and this is going to be on February 22nd on our entry date. Why might we want to enter a trade like this? Well, we generally want to enter a trade like this when we don't think the market's going to go up a whole lot from where we start. So we're in a situation here where we came off this little market crash we had from October to December of 2018. We had a very, very impressive up move here. This is one of the largest up moves, it possibly is the largest up move in this type of a period of time that we've ever seen in the Russell from a point standard. At this point, the market's very overextended. We are coming into some fairly significant resistance levels up here. And our thoughts are the market's going to tend to slow down, maybe run sideways for a while or reverse off of this. Now, ideally, with this position, I would like to get scaled in 2/3. Right? In other words, I'd like the market to go up maybe 20, 25 points or so. I'd like to be able to enter some butterflies here at 1580 and then have the market pull back into this range here or towards the back of the position. If we do that, this trade is very easy. It gets up money very quickly, and we can hit our profit target, which is a very high profit target for a high probability strategy. And we can get out of the market, we can move on. So let's take a look at how this goes. What I'm going to do is I'm just going to move this to the first adjustment. So I'm going to uncheck this. When I uncheck this, it just takes the adjustment off the table. And if you remember, we entered this February 22nd. The market did not go up for us to get scaled in 2/3, but it did come down fairly significantly. If we take a look at the charts, let's see, this is March 8th. And what happened is the market didn't go up enough for us to get scaled in. Realistically, it would have been nicer if I actually entered this maybe a little bit earlier. But we do generally enter at 56 days to expiration. Not that you have to, but that's what we did. The market did pretty much what it should have done. It came up, it touched our resistance level, it ran sideways a bit, and then unfortunately it backed off a little bit more than maybe we wanted it to. So when we take a look at this, this is the area in which we're going to tend to roll this back. The really great part about this strategy is when you're wrong like that and you get a really hard down move, you're generally up money. Now, if you're looking at this, we only have maybe between 9 and 10,000 in it. We're up almost 4,000, so we're up almost 40% on what we actually have in the trade. So that's pretty good. But we do have an adjustment at this point, and that adjustment would be to remove this position here and add or reposition it to 1520. Rolled it back to 1520. And this is what our new position looks like here. Now from here, you can see if the market keeps going down, we would probably be up around $4,000, and then we'd roll back and we'd be up even more money. And as you do that, you get less and less money in the position to the downside. So in other words, we initially had almost 10,000, now we have less than 9,000. And then every time you roll back, it tends to take money out, which is one of the things I really like about the strategy when the market goes down a lot. But the market did not go down a lot. What ended up happening here is I'm going to take off the adjustment and go to the next date. We're in the market for another 10 days. So we've gone from March 8th to March 18th. And now we get our up move. When we get an up move, we have a reference point here of 1520. where our lowest butterflies are, and we're 40 points over that, which is going to give us about 1560, which is where we're at now. Then we go ahead and we add in another third. Now again, ideally, we would like the market here to pull back towards the back side of this new position and take our $15,000. There's a decent chance we'd be up close to that, and move on. And the market did actually come down a bit from here, but it didn't really come down as much as we wanted it to. So if we move, let's take a look at the charting here on March 18th, just so we have an idea. So you can see our bounce right here into March 18th. We ran sideways the next day, and then we actually pulled back a little bit, and then we popped higher. And then we had this down day on March 22nd. Now the interesting thing about this down day here on the 22nd, this was one of the largest one-day moves we've ever seen in the Russell to the downside. A lot of income strategies, or what we call flat T plus zero line strategies, are going to get hurt pretty badly on a down move like that. Let's see how the bearish butterfly did. So let's move this ahead till the 22nd here. Okay, it was 48 points down by the time we hit 330. And if you went till the end of the day, I think it was 54 points down. We are up $7,000. So this is really looking nice here. So let's take a look. Right, this is really looking nice. We actually have a down adjustment if we get down into this 1490 area. But everything is, that never does happen going forward. But everything's looking really nice here. You know, we're 27 days to expiration at this point. Then the following week, I think we got a bit of a bounce. So if we take a look in here, right, the following week we kind of bounced off of that and moved a little bit higher. And if we take a look at what happens here, we go to Thursday, we're up $9,000. Notice we are 21 days to expiration, but we talked about that this date's actually off. It's actually 22 days to expiration. If we go to the Friday, we'll be 21 days to expiration on this graph. And if you remembered when we talked about the trade setup, when we reach 21 days to expiration, we reduce our profit target from $15,000 down to $5,000, and now we are positive $10,000, or a little bit over positive $10,000 in the position. So what we would do is we would close the position out. So this is going to be, for a return, is going to be $10,000 is going to be about a little over 20% of our planned capital. If you're the type of person who looks at how much capital you get into the position, the maximum amount of capital we've had in this is where it is at present, about $19,000. We're up about $10,000. That's a little over 50% of what we have in the position, or the maximum capital we had in the position for the duration of the trade. So that ended up being a really nice trade for the bearish butterfly in April. So that was the bearish butterfly trade. This episode's winning trade. If you have any questions or comments or anything you'd like to see on the next session's winning trade, I'd love to hear from you. So simply post your comment or suggestion in the comment in this video below, and I can get those answered for you. Or even better, you can join us at lockeinyoursuccess.com and experience the many benefits of membership today. I'm looking forward to helping you improve your trading performance and build wealth. I'd like to thank you for joining me today, and we'll see you at the next episode.